Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Perry Rahbar, the CEO and founder of Dv01. It's a fascinating conversation. We start with Perry's kind of entree onto the finance world on the mortgage securitization trading desk at Bear through the financial crisis, the things he learned, and really the insight that led to the formation of Dv01 and its value, which is loan level data transparency for securitizations or investors in the markets generally. Kind of fascinating to me that this didn't exist, and the liquidity and visibility that is unlocked by this kind of capability that Dv01 has built, where they started mostly with fintechs in the unsecured space and where they're headed. Really interesting conversation. I think it's a fascinating both founder story, origin story for the kind of problem they're trying to solve, business growth story in terms of the timing, the things that have happened. And then really interesting, Perry highlights that in many ways, the times when this service is most valuable is when conditions are not ideal, right? Things like the COVID crisis or some of the economic uncertainties that we're facing now, where people are looking for more data and insight and their ability to deliver that. I thought it was a really interesting conversation with a player who's got a unique space in the market and can kind of see across originators and looking at a detailed level of data. So please enjoy this conversation with Perry. Perry, welcome to the podcast, and thanks for making the time. I appreciate you being here.
Of course. Thanks for having me on.
I'm getting used to interviewing non-bankers, but it's still new to me. But I love when I ask most bankers how they got into banking. But for someone who's more on the fintech and entrepreneur side, tell me a little bit about the history of Dv01, kind of where you guys came from, what you saw in the market, why you got into this space.
Yeah, I mean, I definitely wasn't a banker. I was a trader when I started my career, right out of college.
Doesn't that count? That's got to count.
I mean, worked in an investment bank, but I think the trading floor was the furthest thing from banking. I think the traders were often known as like kind of the wild animals within the bank that kind of like roamed around a trading floor. It wouldn't be crazy. Bankers are polished. I think of a banker, a nice suit, tie. You walk onto the trading floor, you have people walking around barefoot. It's just a bizarre place. So that's where I started my career at Bear Stearns, which was also, of all the investment banks, was probably the most ridiculous of all the investment banks. It was kind of smaller culturally. It was definitely not like a JP Morgan or JP Morgan or Goldman Sachs, where it was like this massive diversified business. The department that I worked in, mortgage trading, was really like the epicenter of the bank's profit. So I interned there right out of school while I was in school, and then got a full-time job. And, it was 2004. So what I didn't realize, it was like the preamble to the financial crisis. And it was like slowly building up, and, business got bigger and bigger every year. And it just seemed really exciting. And, I was on the trading desk, trading mortgages, had like a multi-billion-dollar position as like a 23-year-old. And it was.
I've read these books. I feel like this is a whole separate podcast, but
Yeah.
I read books about this, but it's an interesting time.
I read books about it too, like coming into it. Liar's Poker was definitely, one that got me super jacked up about trading. And I was like, yeah, I could see all this happening as I was reading. I read that as an intern. So, it was an awesome place. It was a unique time in history. And then it all blew up. And, so a lot of what led to Dv01 are these moments in time during my trading career that stand out as, kind of, this is ridiculous. This isn't the way that this should happen. The first one of those was when Bear actually went down. I remember it was a Friday afternoon. Our stock was getting hammered all week. It was obviously going lower every day, but I think on that Friday it like closed in the 30s or something like that. Or it was about to close in the 30s. And I sat next to the rates guys. There were a few rows in front of me, and they just got up at one point, threw their headsets down, and said, "It's over." And I'm just like, "What are you talking about?" They're like, "The firm, it's over, it's done. We just got downgraded." So they knew, because they have all the derivatives, they're facing all the counterparties, and there's just no way we were going to be able to post enough margin as a standalone company to kind of meet our new requirements. So they just knew the firm was toast. And like right then, the whole floor got up, and it kind of turned into a giant going away party. Everyone walked to a bar across the street, and it was just like farewells. And it was the most bizarre thing to me. And I remember just kind of like thinking like, what is going on right now? And I got an email from my boss saying, hey, I need you to come back. So I mean, I was still young, and I wasn't. It was like my boss tells me to do something, I go. A lot of other people are older,
Yeah.
like, screw this, he's not my boss anymore. The firm's toast in a way, So I went back, and when I went back on the floor, I saw people like packing up their desks. There was boxes already. I didn't even know where the boxes came from. How did people get boxes that fast to pack up stuff on their desk? And he's like, we need to find out how much exposure we have to mortgages, which at a high level for Fortune 100 company and a tier one investment bank, you think should be, and your primary focus is mortgage backed
Yeah, you
securities.
would think that would be an easy question to answer. You'd
Yeah.
go, yeah, open the books, take a look.
Yeah, it's 3 a.m. We're still there trying to figure it out. All the systems were spitting out different numbers. Ultimately, we had to reconcile everything in a spreadsheet. And I tell, this is a story I tell all new employees at Dv01, because it's a huge, like, we weren't even asking complicated questions about, hey, what's your exposure to mortgages that are 80, over 80 LTV, have like a high DTI or IO, like something like that you would think would identify
In
like
this
a portion.
market that got overheated, whatever it might be.
Yeah, it was just like, what's the number? What's the total number that we own? And we couldn't answer it. And it took a long time. And I thought that was nuts. I mean, absolutely crazy that this wasn't something that was, at that point, no one was looking at loan level data. People were barely doing diligence. So it was just really wild to me. And then there was a few other memories. Once the financial crisis, I moved over to JP Morgan. We're now trading all these bonds. People were selling mortgage-backed securities every day in the billions. And you didn't have any information on most of it. You just pulled it up on Bloomberg, and you saw a high level, what percentage of the pool is delinquent. And that's all you know. And it was tough to know what those loans look like, how many other loans in the pool look like that are most likely going to become delinquent too. You were just kind of like throwing darts at a board. Um,
Yeah.
and what that would do is would just make you naturally more hesitant and bid lower. And then when you start just bidding lower for the sake of bidding lower, it creates like these negative
Yeah.
price, vacuums, and it's just awful for the market because people don't have that transparency. So when I left, ultimately, and I had an entrepreneurial itch, I wanted to do something new. Kind of coincided when when companies like Upstart came about, and the whole fintech movement and consumer lending came about, and it was just an opportunity to build this new infrastructure for these markets. Start with the fintech lenders, and then eventually scale it to the more status quo or non fintech originators or market systems like mortgages, autos, and so forth. And so that's kind of how we got here, and we've been pretty true to that model since.
So, for those who are less familiar with DV01, it's a fascinating origin story. Tell us a little bit what you do, just so we can put the rest of this conversation in context. Like, what is the core set of people you work with, and what are the services you're providing for them?
Yeah, I mean, you could think of us as this data hub in the middle of the market. We're integrated with all the originators, all the banks, all the investors, and we do everything. We do all the data reporting and analytics, which covers, all the market data that some large market data sets could be people specific portfolios, or with something that's been a big focus of ours, and kind of a passion of mine is enhancing transparency within securitization specifically. And so that means that all the data flows into DV01. We cleanse, normalize, validate it, and we've built all the tools for both reporting and analytics that anyone in the ecosystem would need on top of that data. And it just makes it a seamless process. That sounds like, okay, what's the big deal about that? But when you look at how some of these markets operated previously, and how many different vendors or internal stakeholders would be involved in that, and how even data for the same asset class across different counterparties always looks different. Sometimes data from the same counterparty on different portfolios looks different. So there's no good reason for any of that. But our belief was always, if we make this easier and more transparent, it leads to more liquidity in these markets, bigger pool of investors. More liquidity, more investors means lower rates. It's so and helps these markets operate more efficiently, which is the opposite of what we saw happen during the crisis.
Yeah. So let me ask you this: which markets or assets are you in today primarily? Like what kind of assets are you having information, entered into the system and then viewable to the investor side for today? Is it centered around one kind of loan product or securitization category, or is it broader? Like where are you guys playing?
Yeah, I mean, we focused on everything consumer. Any loan that touches a consumer, because at the end of the day, we felt like that impact would ultimately kind of flow back to the consumer in some way. And all these loans that are consumer related kind of function in a similar fashion, right? There is information about the consumer, and then potentially about an asset if there is one. That's all relevant to understanding and evaluating these loans and securities. So I'd say our core has always been consumer unsecured, which
Mm-hmm.
is where the fintech movement started with. But since then, we've touched student, both in school refis, autos, mortgages. Probably our second biggest market. And that's a market that's grown a lot over the last few years. The non-agency mortgage market, or private label mortgage market, is probably a better way to
Mm-hmm.
describe it. And then there's new emerging asset classes that are interesting to us, like solar. Single family rentals has grown a lot, so it's something that we're not currently involved in, but we'll probably start to dip our toes into soon. So it's these are massive markets, and we're talking about hundreds of billions a year in issuance across all of them, and we're still in the small, like maybe double digit coverage or single digit coverage of them. So there's still so much more for us to do.
So let me, I'm very curious, and this was not on my original questions list, but you talk about how obvious an idea it seems, how simple of a concept it seems on a certain level, and yet it wasn't being done. I mean, to your point, like, and I watched The Big Short, and not that that's exactly what you're talking about, but like, kind of like nobody knew what was in was in these deals that they were buying and selling, except for one or two guys who like downloaded something in paper and were looking through the stuff. Why had no one? Why was this not a thing that existed in the market? It seems so obvious, like people are buying and selling assets of a similar kind on a daily basis. There, the kind of Bloomberg exists for certain kinds of information. Why wasn't there something out there that made this an easy thing to do? I would maybe nobody cared, but I would think that if I were buying a lot of these things, I would want to know like what's in this thing I just bought, and how do I think about comparing one securitization versus another based on the actual quality, not just of performance, but of like some number of criteria of the loans within there, where I could look at who's doing a good job underwriting and who's not. And I need the loan level data to do that, and that would seem like an obvious thing, and yet it's not there. And I'm curious if you have a perspective as to why.
Yeah, I mean, there's multiple versions to that, or different layers to that answer. I would say one, just culturally in finance, there's just a natural, and this is why I think when the fintech lenders came about, who really approached this more from a technology standpoint and a technology culture, there was an opening to make this different, is because they believed in transparency, and more information the better, more data the better. In finance, it's the opposite. Like the finance culture is, the less that we have to give, the better, because there's only downside, right? And that's how people think about it in these markets. The pendulum always swings, where sometimes the seller of assets has more leverage, other times the buyer of assets have more leverage. And you would have thought that after the financial crisis, that would have changed significantly. But, in fintech, we kind of, and it's shocking because the company was earlier stage, which is usually tougher to kind of evangelize, but we had a way easier time, selling this value prop to the fintech originators. And then when we tackled it in mortgages, now as a more established company with a proven, business model and like a live product that's being used, there's still a lot of resistance to it, because it's like, what if I give this information out there and it's used against me, which is, by the way, never happened. There's never been a point in our history where some issuer or originator has come to us and said, hey, because of all the transparency you gave investors, they're now grilling us about this, and it's become like, that's never actually happened. We've only enhanced their businesses, and still it's something that's tough for people to understand. Back then, though, I think the big argument for like why, because oftentimes people think of the financial crisis as if a bunch of evil people got in the room and they said, this is how we're going to tank the whole economy. But it was really, we were the dumbest ones, really, right? Like when people are like, oh, you were part of it, It's like Bear Stearns lost the most, Lehman lost the most, and we were, it wasn't like we were the smartest. I think there was just this view that this asset was, when you have thousands of loans coming from across the country, and people thought of housing as a localized, supply demand, kind of economics behind it. They thought that it was safe, and hence with credit enhancement, you could get away with all this, but no one expected the correlation of the housing market to be one. And that's what kind of,
That's what happened.
yeah, because, the finance component of it nationalized housing in a way. And all these big funds, and how they were able to get leverage and so forth. So that was like the historical, and then the thing that we still go up against is just finance culture, and there's still some consumer originators out there that won't let loan level data leave the premise. And I think it's frustrating, but I think that it's only a matter of time, right? Like if you're going to pick which direction is this going, in more data or less data, I'd put my money on more data.
More data,
Obviously, I'm
more. I mean,
biased. More data
yeah.
being
Well, I just
available.
like if I'm buying a thing, knowing what the thing is doesn't seem. I mean, at the core, the thing is the loans, right? It's the. I mean, to really judge the risk of a securitization, a portfolio, or for anything, you've got to know the thing. I want to ask you this: you talked about starting with the fintechs, or kind of maybe the luck of kind of starting the company at the same time that a bunch of fintech lenders who also started, who had maybe a similar mindset. Are there other ways in which you find the fintech players in the market to be different, or to think differently in interesting ways than the more traditional banks? Like, how are they different as customers, as partners? I'm curious what your perspective is on how the difference between those two kind of categories of player in the space.
Yeah, I mean, I think they're just thinking about it in a very proactive way, very hands-on, and getting in front of things, and appreciating quick feedback loops. I think COVID was probably the best demonstration of that. When everything started in March, this is always the consumer unsecured is always a loan that for the longest time
Sharpen the spear.
I heard was exactly the tip of the spear. And if you know quote unquote shit hit the fan, that would be the first thing to go. It was what I always heard when I talked to like my old finance friends. And it took a long time for it to be kind of evangelized within the broader capital markets, and really get the money manager audience and so forth. So when COVID hit, everyone thought those loans were going to go really quickly. And again, that's the thing, right? In absence of information and transparency, people will assume the worst and sell. And that would have been bad news, and a lot of people could have easily gone out of business. And then the counterintuitive thing happened, which was with the stimulus money, people actually kept paying their loans, and we saw how quickly the fintech segment modified loans, made it very clear, and also worked with us across, hey, how's everyone else doing it? Let's get synchronized because it's good for the industry. And consistent logic, and we were able to implement it, and we're also getting data daily, which is something that doesn't happen in other markets. So we were able to put out these reports and really show what is happening every 2 weeks, a refresh of what is happening. And I think for many reasons that market, I mean, one, was down maybe 2 weeks and then never turned back. Versus you look at the mortgage world, I mean, there was carnage in mortgages for, most of 2020. And, people still never really got a good handle because it's such a distributed ecosystem and so many stakeholders. So it's really tough to have this like market consensus and think for the best of the market. There's servicers, there's originators, there's aggregators, there's securitizers. It's just a really tough ecosystem. So when you look at how efficient the fintech guys are, and you could go to 5 different counterparties and get some sort of consensus, and do things pretty quickly, and then it could be deployed internally pretty quickly, which is the other thing, right? Try to go to a mortgage servicer and ask them like, hey, can you add this field, or can you change how this field's done? I mean, forget about it. That's like, that might happen within a year if you're lucky.
Yeah, I remember looking at this data very carefully during, we were using this a lot with our partners, with our investors, because they were saying, well, what's happening? We know what's happening to you. What's happening in the broader market? What's going on? How are you performing versus the broader market? Are you better, worse? Is everybody kind of the same in terms of stress? And the ability to look at impairments across the industry And I think that was kind of the term we all came up with. That was like not either in a hardship or late, roughly speaking, but not making on time payments was a hugely valuable thing. And to have it in real time where we could, I was sending out a weekly email to all of our partners. And that data was at the core of a lot of the analysis we were doing about where the market was at. So that was amazing how the speed was able to make it faster to learn. And to your point, for the market to respond and go, hey, things don't look like they're as bad as we thought they might be. Maybe it's not such a bad idea to be in this, to still be in this space.
Yeah, I mean, that was, I got to tell you, I think in looking back, I mean, we're in our 8th year. October will be 8 years. I'd say that's probably one of the most fulfilling periods, which is shocking because it was also a moment where I thought the future of the business was the most imperiled because securitizations just stopped. And that's a big, source of our growth. But it was the most fulfilling because that moment was exactly what we started this company for. And what the vision was about was in moments like that, giving people confidence instead of having them retreat in fear. And listen, confidence in it being bad is just as good, right? Like, I mean, I think, again, if people understand what is actually happening, good or bad, that's extremely important and they could adjust accordingly. It's when people are blindsided or just way out of touch with reality in a negative way where it could wreak havoc in the markets. And so that was great to see. And I think, like, the whole community came together and figured that out. And it was just so unique how different it was in the consumer space for us and for investors versus what it was in the mortgage space, where people really didn't have answers and couldn't really understand it. And it took a lot longer for that market to kind of come back. And then, obviously the tide was so strong with stimulus and rates and so forth that it just, I don't think anyone actually got answers. They just moved on. And it was, and that's,
Well, let me ask you that question, because I think we're recording this in early June, so maybe we'll have to make this more timely in our production. But it's a really interesting moment to ask what's happening. So I think there's a sense that there was a really big shock. It was offset by stimulus, and at least I'll talk mostly about consumer loans here. We rode through 6 of the maybe best months ever from a performance point of view on the tail end of what looked like a pretty scary time. But as stimulus is withdrawn, inflation has gone up, supply chain has tightened. There's concerns that the piper has come to collect his due. What's your sense of what the go forward is? Because I think people are definitely looking at some degree of at least the good times that we had over the last 6 months that were unnaturally good in many ways because of government intervention. And do you have a perspective on where you think, I want to ask you to put your crystal ball and predict the future, but where we're at from that performance point of view in that category? Because it is something I get asked a lot. And how much are we going to revert to, pre 2020 norm, something in between? Like what does the credit risk environment look like moving forward, and what are we seeing in the portfolio? Because it's this interesting moment when the stimulus is going away, inflation is going up, and some of the things that have been sustaining the really good performance are maybe not going to be here for the future.
Yeah, I mean, this is the thing that's when you're kind of in these phases where there's a lot of uncertainty, it's tough to know what's really driving what. And it's particularly in consumer loans, because again, tip of the spear. But I would say we're exiting a period that was very unnatural, right? The amount of stimulus that was pumped into the system. So if your baseline is the last 2 years, well, of course it's only going to get worse, right? Like, it's just, and I think there's oftentimes people look at stuff and they're like, oh, delinquencies are ticking up. Well, of course. I mean, that was insanely low.
They were too low.
Yeah, it was
they were crazy low.
A lot of people would say they were definitely too low, and they should have been higher. And I would agree with that too. So I think, and also the other thing is, in these environments, right? So credit's so good oftentimes, and originators then start opening up the box a little bit and stretching. So is it really, when you have this uptick in delinquencies, is it because the people that you were lending to previously got worse, or you expanded to the fringes a little bit, so naturally you're gonna have higher risk associated with that? So I think, like, that's kind of what we're seeing, is a little bit of mix of both of those things. Obviously, the environment's not what it was the last 2 years, but I do think people are sitting on record savings. And, I think, on the other side of the table, a lot of our partners on the origination side kind of expanded the box a little bit, and that's the first stuff that you'll start to see go bad. But is it going to be a wave? I think that's probably not in the cards. I think if anything, and you could answer this question better than I can. I know there's a lot of volatility out there, but ultimately, if we get into this system where higher inflation and savings start to come down, there might be more demand for credit. I think we've also been in this period where, because everyone was so flush with cash, it's an insanely low period of demand for credit, and hence why there was this need to kind of expand out. And maybe that's what's flowing through. So maybe originators like
Yeah.
Upstart could start going back to the customer that had too much cash and giving them credit, and that's probably someone that they'd feel better about than the person that they had to stretch with.
Yeah, I mean, I think you're right. There are reasons to be nervous, right? There's also reasons to think, hey, credit is going to be more in need. We often get asked about rising rates and what they do. And I go, well, a lot of consumer unsecured is refinancing of credit card debt, which is almost all at floating rates. So yeah, your rates probably have to go up as rates go up, but so does the alternative that the consumer is facing. And so does that, like the cost that they're looking at on their current borrowing. So maybe the value of a refi goes, it's hard to say. We haven't, people asked us what inflation does to credit risk. And I said, well, given that our data is like 15 years old, we don't have any good data on that. We don't, over the last period of years, you don't have a lot of experience with inflation where it's at. So it's there's a lot of unknowns, but I think there's a lot of reasons to be positive, and we don't see, well, I guess Jamie Dimon sees a hurricane on the horizon, but we see something a little more mild in terms of the correction.
Yeah, and I would imagine, my if I had to bet on it, I wouldn't, I would think that there's more demand for your types of loans for the remainder of the year, which is something that is ultimately great for us as well. And
Yep.
I think for us, I think the sweet spot for us where our business excels is where if there's enough uncertainty where people actually have to pay attention to what's happening in the underlying collateral and the loans, but not too much where it just shuts down the markets. And I think that's kind of, once we do settle in this kind of in a rate range, and I think people feel comfortable making decisions again, and the 10-year note isn't moving like a tech stock, I think we could get back to some sort of business as usual. And then I think it would be an interesting environment where there'll probably be a lot of different views. We haven't had that in a while.
Yeah, it'll definitely be interesting. So what's next for Dv01? Like, where is there a future you guys are looking for that you want to build? Most entrepreneurs have some vision of where they're headed or what they want to get to next. What's on the roadmap for you guys?
I mean, for us, it's it doesn't actually involve a ton of new products. It's constantly pushing to get more data on the platform. It's bringing on a lot of new partners. When we look at kind of our securitization business, which was basically what we did there, is we came up with a new role within a securitization itself called a loan data agent. And so, the way it used to work is there was either no data available, or there was market data sets that were sold or posted by different institutions, and everyone had to do all this stuff to get it together. But in a lot of asset classes, there just wasn't data available. So, our goal is to get all these issuers to start including a loan data agent on their deals, and it really streamlines how investors and even the originators themselves. Oftentimes, it's funny, they think they're doing it for investors, and then they become the biggest power users of the platform. And get the most value from it, which is always, I think, great for us to see. But like I said earlier, we've barely scratched the surface of penetrating these markets. Even in our best market consumer, we still only have, of all consumer unsecured, maybe 70% of securitizations on our platform. There's a few big issuers that are not necessarily considered fintech issuers, which aren't on the platform yet. In mortgages, we're even lower. Solar is another one that's up and coming. Autos is another one that we want to penetrate further into. So in our mind, we still have a lot of work to do. And a lot of that in terms of what it means for us in product is it is just enhancing the infrastructure to make it easier to take in this data, adding some new schemas to the system, adding new features on the other side to make it more powerful for investors. But the securitization market is really the heart of what we do. We also build a lot of other tools and sell data sets, but there's so much data in these markets that's still out there that's not on our platform. And that's kind of what we're looking towards, to really, get all the data and have it all.
In a true platform model, that's what makes the platform more
Yeah.
valuable, right? To all parties who are playing. I wanted to, before I get to my closing three questions, follow up on something you mentioned earlier that I made a note of, which is this kind of like the belief and part of the driving motivation for what you're doing, that transparency in the market and open data would lead to better outcomes, accessibility of credit for consumers, that kind of focus on driving some consumer good. And I'm curious how you think about maintaining a focus on that for your team. I mean, it's hard. I find that many financial institutions, even for people running consumer lending businesses, can find it hard because you start to look at portfolio level and you forget the people behind the numbers. But I imagine for you guys, you're a step removed from that originator in terms of your place in the value chain. And I don't disagree necessarily that more efficient, better functioning markets end up enabling better offers for consumers at the end of the day. That's definitely true. But it can be hard to connect the dots for your typical Dv01 employee between what you're doing and how that actually impacts consumers at the end of the day. And I'm curious how you think about, from a cultural point of view, making that connection and driving that focus on saying, hey, we're not just here to like move some numbers around and make some money, but we're here to actually make this market more efficient because it's good for the American economy, the American consumer. How do you think about maintaining that focus and helping people connect what they're doing to that greater mission?
Yeah, I mean, it's definitely tough, right? I don't try to like pump it as if every day that's what's going on to some degree. I think
Yeah.
we are a few steps removed, but I think there's these moments in time where it's really clear. And the COVID example is one. I think we're getting into another one right now where
Mm-hmm.
I know for example, listening to earnings of a lot of the consumer originators, in terms of your future output for the year, it's not as much, can we originate loans to investors or borrowers? There's a lot of demand for that. It's, can we sell it all to the capital markets? And, not knowing what kind of environment we are in the capital markets. And so I think it's specifically during these types of times. And we also do, panels as well. And we invite some guests and investors and so forth. And it really shows to the team kind of how there is a lot of uncertainty and how the data really does play into shaping views and coming up with decisions. We also get a lot of feedback from investors when we're putting out content, like the COVID reports specifically were huge. A few people on our team were really behind that, and like, this really helps. Thank you. So you have these moments in time, and I think the other thing that employees on in our company realize sometimes, you could get like a bit desensitized to it, and then you realize, wow, these are massive sums of money that we're kind of dealing with here, right? There's deals, securitizations that are being done. We've had some deals that are over 2 billion. We have some clients on the platform that are bringing over 5 to 10 billion of loans that they own onto the platform, and we're a critical part of that. And behind all of that are loans that are taken out by people, and if they're not able to, I think people who've been at the company long enough are able to see, if they're not able to get a good enough handle on what it is they own and how they look at this risk, then they might not make those decisions. And that's way easier to kind
Mm-hmm.
of show to the team in moments like this versus, I'd say pre-COVID, it was a pretty strong bull market, and I think we've done a lot in a bull market, which is actually the most impressive. For us, this is the time to really continue to grow the penetration percentages, because this is where the value prop is the strongest. But in good times, it's really tough to it's harder to make that kind of connection.
Yeah, that's true. I like it. So I've got three questions I use to close the podcast with everybody. So here they are for
Oh
you,
boy.
Perry. Number one, what's the best piece of career advice you've ever gotten?
It's nothing unique, but it's, don't get locked in on the outcome, and really enjoy the process. And I think as an entrepreneur, you could
Mhm.
always think, like, you get lost in, well, where's this all going to end? How's it going to play out? And when you look back, I think one of the craziest, like, entrepreneur hacks I give other founders is download Time Hop on your phone, which is, I don't know if you've heard of it. It's an app that just shows you every day pictures from this day, 1 year, 2 year, 3 year, however many years
Mhm.
ago. And I get these reminders every day of where we were at like 7 years ago. And it was just a bunch of diagrams on a whiteboard. And it's a great reminder
Yeah, yeah,
of, one, how fun that was, but how absolutely terrifying of a time it was. And really just enjoy it. And these things end up working themselves out.
Yeah, the other thing that I'm always reminded, because our CEO and I are both bad on the celebration. Like we tend to be focused on
Yeah,
what's next, and we've got certain members of our team like, hey, we need to step back, take a moment, and like just recognize what we just did, celebrate, make sure the team like kind of feels that moment. And I'm always appreciative because my inclination is just like, no, we finished that one. I got to worry about the next one. And when you're an entrepreneur, there's always a next one that's equally big and terrifying and exciting, and it's important to kind of
I've
mark the
gotten that
moments
feedback a
a
few
little bit.
times myself. And so just for sure, I've been called out on that.
Yeah. So I'm always grateful. I've got a team member, one or two in particular, who are always like, Jeff, we got to. I was like, thank you for doing that for me, because it would not be me, and I know it's probably pretty important for the group. Um, Second, what's the best piece of advice you've gotten? This would be an interesting one for you about the consumer lending space in general. Like, what's an insight you've gleaned from your time and looking at it broadly across the market?
What's the best piece of advice or insight?
It's a pretty broad one, particularly since you're right in the middle of
I
that.
feel like I've been the one that's had to give out advice on it because everyone comes to me, and ask questions about it since they think we have all the answers.
What's the best advice you give?
Early days, I think it was just that there was a lot of people that were so skeptical of it, and there was just people who were like, who are these people who are taking out these loans over the internet? And I'm like, what do like, as if it's all fraud. And they review, and it's funny, these are the same people who bought all the worst stuff during the financial crisis or originated all the worst stuff. So it
Yeah.
was just about taking this asset class seriously and taking these originators seriously. I think a lot of people early days, especially from the finance community, just thought that these were tech people who didn't really understand the markets. And to some degree, there was some truth to that. I think there was this belief it could
Mhm.
truly be a peer-to-peer system, and there's just no way that was ever going to scale. And they figured it out, and it's kind of just like the same entrepreneurial advice. You just keep going and you figure it out, right? And now I don't think anyone has those doubts about this market for sure.
All right, so I have one question left, which is, what's one bold prediction for the future?
I mean, it's just, I guess, my bold predictions in economic view. I don't think it's gonna. I mean, I'm definitely not at Jamie Dimon's level, but I don't think it's going to be as bad as everyone's making it out to seem. Like, granted, unless there's some other geopolitical shock that is waiting in the corners, but I think it's going to kind of just work itself out. I think the Fed will end up controlling this, and you can just see it in the rate markets. Like, there's no real consensus on what's going to happen, and if the rates are going down because people are worried about a recession, well, that and that soft landing is a possibility. Then I think it will kind of just be where we need to land.
I like that bold prediction. Although I will say, I made a similar prediction about 2.5 years ago, and I said, barring any major geopolitical events like a pandemic or a war, I was in a bank's boardroom, and man, called me a couple months later and went, and I said, like I said, unless there's something crazy.
COVID counts as geopolitical, right? Like, I mean,
That's got to count, right?
yeah,
That was
you're covered there.
unexpected, but I thought it was kind of amusing. I was like a couple, like a month or two before. I'm like, barring anything crazy happening in the world, and then there we were. But bold prediction. It's not going to be as bad as some people worry. I like it. Perry, thanks for making the time. This was a great conversation. A lot of useful insights. I really appreciate you being here.
Thanks for having me. Take care.